Tensions between the United States and China have taken a sharp new turn. Reports now indicate that China may begin reducing its holdings of U.S. debt, a move aimed at shielding its trade from sudden shifts in currency markets. Meanwhile, stocks and bonds are once again under pressure, as investors grow anxious about what China might be doing with its U.S. Treasury securities. China's response to tariffs is now reaching beyond trade, extending into the realms of soft power and financial pressure. Could China really be dumping U.S. Treasuries on a large scale? Imagine this. With each passing minute, the U.S. adds over $4 million to its debt load. Now consider what would happen if its largest foreign lender, China, suddenly pulled out. What once sounded far-fetched is now actually unfolding. China has reportedly unloaded $1.7 trillion worth of U.S. Treasury bonds, an abrupt move that came just after American banking giants like J.P. Morgan and Bank of America cut financial ties with several Chinese firms, including their planned IPOs in Hong Kong. Just in the second quarter of 2025 alone, the U.S. Treasury had to scramble to borrow another $514 billion to cover the massive shortfall created by China's exit. To make matters worse, the U.S. dollar took a hit, falling by as much as 9% in value, while investors rushed into gold and non-dollar assets for safety. Now comes the real question. How long can the U.S. economy keep standing if China is ready to launch a full-scale financial offensive? The answer unfolds in today's video. Let's dive deeper into this story with Deep State. Be sure to subscribe and turn on notifications so you won't miss any of our latest updates. On March 27, 2025, alarm bells rang inside the executive suites of J.P. Morgan and Bank of America. Following a direct call from Washington, U.S. Congress issued an emergency order. Both banks were to immediately step away from underwriting the multi-billion-dollar IPO of CATL, China's leading EV battery maker, which was preparing to go public in Hong Kong. The U.S. Department of Defense had officially labeled CATL a Chinese military-linked company under Section 126 of the National Defense Authorization Act. The letter pointed to serious concerns, namely that helping CATL raise funds would strengthen China's military and support human rights abuses, all while giving an edge to the Chinese Communist Party. This was a bold and rare move, one that made it clear the United States is willing to weaponize global finance to defend national interests and core Western values against Beijing's growing influence. But why would an IPO, which is basically just the first public sale of a company's shares, spark such an intense reaction in Washington? Here's why. CATL is no ordinary business. Aiming to raise between $4 billion and $5.3 billion, CATL has the potential to aggressively scale and dominate the global electric vehicle battery market, a sector the United States sees as critical to national security. To Washington, this is not just about economics. It's part of a long-term contest for global power, especially in the areas of technology and geopolitics. What's more worrying for U.S. leaders is that top American banks were backing a Chinese firm that's already expanding its control on the global stage. An April 2025 report by the International Institute for Strategic Studies confirmed what many feared. China is rapidly catching up to the United States in vital technologies, particularly artificial intelligence. One standout example is DeepSeek, a Chinese AI company whose model reportedly rivals the best U.S. systems, but at a much lower cost. This poses a serious strategic threat. Faced with that reality, Washington made its move, ordering J.P. Morgan and Bank of America to fully back out of the IPO, even though they knew it would come with a steep price. Those banks weren't just giving up future profits, they were also risking access to other high-value Chinese deals down the line. According to Reuters, CATL's underwriting fee was just around 0.2%, but because of the sheer size of the offering, each bank stood to make tens of millions of dollars. And perhaps even more valuable than the cash was the opportunity to build long-term relationships with some of China's most powerful corporations. However, the deeper consequence that Washington may have overlooked is the slow breakdown of global financial trust. When the U.S. chooses to weaponize its banking system, it causes international investors to grow wary of doing business with American institutions. This concern was clearly raised by former U.S. Treasury Secretary Lawrence Summers during an interview on CNBC in April 2025. He cautioned that today's harsh financial and trade measures could spark a serious financial meltdown and fast-track the economic separation between the U.S. and the rest of the world. As many foresaw, Beijing acted quickly and decisively, unloading up to $1.7 trillion in U.S. Treasury bonds. This move forced Washington to rush and secure over $500 billion in emergency borrowing, all within a single quarter. The impact was not just financial. It led to a crash in the U.S. dollar and set off panic across global markets. It's clear the U.S. has ignited a complex and high-risk financial conflict. But the question remains, is the U.S. prepared to handle the consequences of its own aggressive strategies? And how will China's powerful response reshape America's global financial power? Join Deep State as we dive deeper into this critical story in the next chapter. After the United States ordered its biggest banks to pull out of a Chinese IPO deal, Beijing hit back with a strong countermeasure, a large-scale sell-off of U.S. government debt. In the first quarter of 2025, China slashed its holdings of U.S. Treasuries to around $759 billion, the lowest level since 2016. This wasn't just retaliation. It was a part of China's long-term push to cut down its reliance on the U.S. dollar. China redirected its investments toward gold bricks development bonds and yuan-based assets, signaling a broader global movement. More nations are now diversifying their foreign reserves, trying to reduce dependence on the dollar. China's de-dollarization strategy involves not only dumping U.S. treasuries, but also stockpiling gold and broadening its reserve portfolio. By March 2025, the People's Bank of China had lifted its total gold reserves to 2,292 tons, making up about 6.5% of the country's total foreign reserves. In just the first quarter, China added 12.8 tons of gold, marking its fifth straight month of increases. According to IMF figures, the dollar's share of global reserves has dropped from 64.7% in 2016 to just 57.4% by the third quarter of 2024. China's efforts are now directly challenging the dollar's dominance, possibly changing how the global financial system is built in the years to come. But this bond sell-off does more than shake up financial charts. It hits American households directly. With China stepping away from U.S. debt, bond yields rise, making it more expensive for both the U.S. government and its people to borrow money. That could translate into higher taxes or budget cuts in critical areas like healthcare, education, and social safety nets. Also, as the dollar weakens due to shrinking global trust, the cost of imports goes up, fueling inflation and eroding the purchasing power of everyday Americans. This hits low and middle-income families hardest, those already struggling with rising costs. To sum up, China's strategic dumping of U.S. bonds isn't just an economic move, it's a clear geopolitical message. The aim is to challenge the dollar's grip and weaken American influence. This presents serious risks to the U.S. economy and demands urgent and strategic action from policymakers. Following China's move, global markets experienced a massive withdrawal of foreign capital. In the first quarter of 2025, foreign investors sold off roughly $317 billion in U.S. assets, including both government bonds and stocks, the largest liquidation since 2016. Multiple countries, including China, Saudi Arabia, Japan, and Germany, are pulling back from U.S. Treasury bonds, reducing their reliance on the U.S. dollar. This has weakened the U.S. economy, which hit its lowest point in 16 months by early 2025. At the same time, Congress forced U.S. investment firms to divest from Chinese companies, hurting U.S.-China financial ties and reducing foreign interest in American stock markets. This shift raised borrowing costs, increased inflation, and made daily life more expensive for Americans. To deal with falling revenues, the U.S. Treasury raised its borrowing estimate to a record $514 billion, pushing up interest rates and slowing economic growth. Major U.S. companies like Apple are also facing higher costs due to new tariffs. Meanwhile, China is building its own financial system, including a national credit rating agency and internal payment networks, to reduce dependence on the West. BRICS countries have launched BRICS Pay, A decentralized system that allows them to trade in local currencies, reducing their use of the US dollar. These changes signal a growing global shift away from Western financial control. While US firms like JP Morgan and Goldman Sachs remain dominant, their lead is shrinking as BRICS and other countries create alternative financial systems. The key question now is whether the US will adapt to this changing landscape or stick to its old strategies. Either way, the outcome will shape America's economic future and global power. Make sure to subscribe and turn on notifications so you don't miss any of 3 Daily News' latest updates.